Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. Taking a look at UOA Today, unusual option activity, UOA on Qualcomm, where some big time repeat call buying, especially, sets up ideally for a couple ways to capture that huge jump in implied volatility accompanied with that call buying out there on a overvalued and overbought Qualcomm. So let's jump in and take a look, shall we? First of all, here's one of the scanners that I use. Here you can see Qualcomm showing up certainly in the top 10 on the list. Almost 400,000 contracts traded on Friday versus less than 100,000 normally, right? So more than 4 times the normal volume. You can see the stock did pop on the day. Earnings have already come out, right? And you can also see that implied volatility now at 100%. In other words, option prices have not been this expensive in the past year ever. Another scanner, this is the one that I built on the Thinkorswim platform. You can see all of the Qualcomm options showing up here. So this is kind of unusual option activity, right? That has an increase in implied volatility. You can see all the massive call buying out there. So take a look at what happened with IV. You can see here is the IV on the 120-day options, right? Now at by far the highest level over the past year. We talked about it earlier, did have this huge run up, and then the pullback, which we kind of expected, took off our iron condor trade for a gain. Now we're seeing it rip even higher, setting up for a similar trade, iron condor, and a similar sell straddle. You can also see how implied volatility moved from Thursday's close in red to Friday's close in green here. Just a huge jump in implied volatility, all because of that massive unusual option activity, mostly on the call side. With the stock rising, right, normally you see implied volatility come down, not in these kind of AI chip related names. They just get the speculative fervor, which sets up, as we've seen in the past on our trades, for ideally capturing the IV in a couple ways. Here's another look at implied volatility. Here were earnings, right? The normal run up before earnings, then the vol crush. But you can see since May 14th, when vol finally reverted a little bit right below 70, now we're pushing back towards 80. We're seeing the call IV even higher than the put IV, so the call skew increasing as well. Here's that IV percentile, as we talked about, at the 100th percentile. So options have never been this expensive. Here you can see the different months, the jump from Thursday to Friday. So we're going to be looking out to a June iron condor, right, at a nice pop, right, huge volume there, right, and a September one as well. So I pulled off basically a 120-day 5-year IV chart on an at-the-money 50 delta call. You can see just the massive spike here. We talked about this a little over a week ago on our previous trade on Qualcomm, right? Now spiking higher to the highest level basically we have ever seen on Qualcomm options, right? Here's a look at it on a shorter term basis, a 6-month look, right? You can see fairly well behaved, hovering below 40 right now. We're over 70, right? And at by far the highest level over the past 6 months, no question at all. Here is the puts and calls both, because of put call parity, they move in unison. You can see again that huge spike did get that reversion, but once again, right, with that huge massive call buying, seeing that pop. So we expect IV to revert back. And here's a couple trades to take advantage of that expected reversion on a overbought and overvalued Qualcomm stock. So a straddle play, right, simply going out and selling the September 250 straddle. So I pulled it off from May 6th to close, right? The stock Qualcomm at the time was what, 186.55, right? That September 250 straddle that had 135 days to go, right? Trading just over 75 bucks, trading just over a 50 IV. Fast forward to Friday's close, you can see the stock closed at 238.16, so up over 50 points, moving towards that ideal 250 strike price, right? If you sell a straddle, you want it to move to the strike price, right? But because of the massive jump in IV, the straddle, as we'll see in a second, got more expensive. Have only 118 days now. Back then, had 135, so a couple weeks passed, right? The stock up massively to the ideal price, but that straddle actually is now 4 points higher now with the stock at 238 and change versus back then a couple weeks ago, right? With the stock at 186.55. Why? Because IV is now well over 70, not hanging around 50. So did a quick comparative here. Here is the May 6th kind of data, right? The stock was at 186.55. The delta on that sell straddle, right? Selling that in the money put, right? Deeply in the money by about 75 points, right? Carries a negative 78 delta. So if you sell it, it'd be 78 deltas net long. Selling this, 22 deltas net short, right? So that gives you a combined net delta, 56 deltas net long, so bullish, right? The theta on the trade, which is the time decay per day, right? 12, so you expect to make 12 cents a day, right? Each option expected to lose about 6 cents a day on the trade. IV back then, as we said, just over 50. Fast forward to Friday's close, right? The stock at 238.16, we had a little bit over 2 weeks of time passing, right? So you'd expect that theta to certainly have this trade become profitable if you sold it earlier at 75, right? You can see the stock moved up 51 and change, right? And over the course of it, you still would have been long delta. Now you're short 8 delta, started at 56. That smooth delta, if you will, of 24, you'd expect a gain being long, having the stock move up on the trade. But because of the IV jump, you're actually having the trade 4 points to the loser, 4 points more expensive. Plus, the theta now is at 32 because of that huge jump in implied volatility. Option prices are much more expensive, right? So your theta now is about 15 or 16 cents on each option, right? So you have positive theta in a much bigger way, which is another benefit of selling this vol. So if you want to take advantage of the IV pop and do it in a somewhat neutral fashion, right? Certainly going out, selling the straddle, that September 250 straddle, which although it's moved 50 points towards the ideal price, you've had 2 weeks pass in time, has gotten 4 points more expensive. So that's certainly a great way to play it. Why did it pop 4 points where it should have been down, right? You should have been able to gain both from the delta gain over 12 points, the theta gain over 3 points. You should have been up about 15 bucks. So if you would have sold it earlier around 75, should be trading around 60, but because of that huge jump in IV, right, of over 40% IV moving from 51 to over 72, you're actually seeing the trade go up another 4 points. It should have been down about 20 bucks or 15 bucks. Instead, it's up about 4, so about a 20-point differential. So that's certainly one way to play it. We'll be doing that on the open on Tuesday. You can see the theoreticals here. Pulled those off and simply put in where the IV is at today, and then moved it down 5 vol points. In other words, not a huge drop, right? Just moving from up here to down here, not looking for a huge collapse in IV. But you can see the trade, as we said, trading right around $79, selling that SEP 250 straddle, right? The delta on the straddle, you'd be about 8.5 delta short if you did it. So fairly neutral, no question. If we lower the vol 5 vol points only, right, you can see the calls go down in price sharply, right, from that previous price, here of 34 almost. You can see now here they're almost 31, so you pick up a huge drop on the call price from that drop in IV. The puts go down to 42.30, right? Theoretically, before they're about 45. So that straddle, that if you sell it based on Friday's close at somewhere around 79, is now worth about 73.5, simply by having IV drop just 5 points, right? Basically revert back to where it was Thursday, right? Which not all the way back to those, low levels down here. We're just looking for a move back towards this level here. So you can also see the delta on that sell straddle, right, actually lowers, right? So lower IV makes the delta less bearish, if you will, more neutral. So another benefit on that as well. Another way to play it, if you want to do a defined risk, is simple iron condor trades. These are similar to that triumvirate that I came up with earlier with Qualcomm, Micron, and Intel. All of those worked out very nicely, right, as the stocks quit ripping insanely to the upside and IV came back down, able to make money on all of those. But here at Qualcomm, as you can see, simply going out, selling the shorter term, the June, 27 days to go, 300, 310 calls. At the same time, the 195, 185 put spread, right, for about $2 net credit. So your max gain, $200. Your max risk is simply 10-point wide, right, less the 200 received, $800 max risk, right, only one side can get in trouble. So your return on risk is 25% for 27 days or so. Upside break even on the trade, the short strike price plus the premium, so 302 is the upside break even. You have about 63, almost 64 points of upside cushion, over 25% for the stock to further go up over the next less than a month, right? Downside break even, 193, the 195 short strike price less the $2 received, 45 points of downside cushion, so almost 20% for less than a month's time frame. So that's another way to play it. Do it in a defined risk way, risking $800 to make 225% gain, as long as Qualcomm, right, doesn't rip insanely from here, right? Plus, if IV drops as we expect and time passes, right, you can certainly cover that trade before expiration for a gain, like we did on those previous iron condor based UOA trades on Micron, Intel, and Qualcomm. So hopefully it provides insight into how we go about identifying trade opportunities here and how we look to find the edge, then put on the hedge. So until next time, as always, here's the good trading.